So SFM equity valuation Dawn series class 1. Okay, equity valuation class 1. If you remember in the classes, when you remember the chapter equity valuation, the most prominent stuff was dividend discount model. All the stuff like D1 by RE minus G or the multiple growth DDM. Okay, all that stuff, DDM. We did a number of sums on dividend discount model and they are most common in the exam. Then the next portion was the free cash flow model, the FCFF and the FCFE. Correct? Connected to the FCFF model was the Alcar approach, where we find out the value of a strategy. I think Alcar approach is very important for the exam. So therefore, I would pay special attention to it. Although free cash flow model, the general sums are more conceptual. Okay, you should be revising that. After completing the free cash flow model, we went into relative valuation. Relative valuation means the use of P ratio, price to sales ratio, price to book value ratio, EV to EBITDA ratio and so on. After doing the relative valuation, we went to residual valuation. Residual valuation as in economic value added and market value added, EVA. After finishing of that, we went on to accounting based valuation. Valuation on the basis of how we do it in financial reporting. Okay, whether the income capitalization approach or the balance sheet intrinsic value approach. We also did some side topics like bonus issue, rights issue, buyback, and recently in the examinations we are getting some general sums on ratio, like sums on capital structure, sums on EFR, external funds requirement, EFR. Plus, do remember that there was a short discussion on technical analysis where we did exponential moving average, EMA, exponential moving average. So I'll just repeat the whole stuff of equity that we have. Just one second. If you want, you can note it down. When we talk about equity, in that case, I can divide into three. One is fundamental, second is technical, and the third is side topics, side. Now technical may we have a single sum called exponential moving average. I have not taken it in my sheet, but you need to remember, you need to do one sum on EMA. If it comes in the exam, you will be repenting. Exponential moving average, you got to do it, please. Okay, it has been done in class. You have to prepare those columns, days, actual price 80, previous EMA, FT minus 1, error term ET, alpha into ET, and then FT. You have to prepare. One sum is necessary. Then in the side topics we have dividend policy, because although dividend policy is removed, but sums on buyback do come in. In fact, you also have formulas on Walter model. Okay, Walter model, although sums have not come, but in the formula is given in the book. You have buyback. Should we go for buyback? Okay. Second is bonus. Third is rights issue. So these are like side topics. And fourth is external funds required, comma, capital structure and ratio analysis and ratios. Okay, a common sense idea of ratios. External funds required, capital structure and ratios if you are writing, because these are the stuff that we lose out. Okay, and they come in the exam then. Now fundamental analysis, it's all about valuation, where we do DDM, where we do free cash flow approach including Alcar model. Then we have the relative valuation, that is the P ratio and all that. Relative valuation. Okay. The chop shop and all that comes in relative valuation. Then we have the residual valuation, the EVA stuff. Then accounting valuation, income capitalization approach and all that. Accounting valuation. Okay, so this is the fundamental part. Okay, and technical part, exponential moving average, I'm sure some people will forget looking at it, and then it hits the exam. And these are the tertiary parts. Out of the tertiary parts, in recent terms, this topic has been tested and ratio figures have also been tested. So once again, this is something that you will lose out. Okay, you may complain that sir, EFR was not done in class. Okay, yes, it was not, because from where from does it come in the syllabus? How does it come in the syllabus? We only know it comes in the syllabus when it comes in the exam. Okay, perfect. So right now, in my first class of equity valuation in the Dawn series, I will think about revising these two stuff for you, the EVA and the Alcar model. Please understand, both of them have been done in class, which means even if you don't watch this video after this point of time, it is sufficient. You just do the sums of EVA and Alcar model that are given in the sheet. Na? You are through. This is not a new stuff which I am doing. We have already done it in class, economic value added. Okay, so let me revise the stuff for you. You know, economic value added is essentially economic profit, and a company is said to be earning economic profit if it earns a return which is greater than what is required by the providers of capital. So EVA is NOPAT minus NOPAT minus KC into capital employed. KC into capital employed. If I speak accurately, it should be EVA for the Tth year is NOPAT for the Tth year minus KC into capital employed at the end of the T minus 1th year. However, I have in my life in CA seen only one sum where such information was given, so that the last year's capital employed, you find out the KC into capital employed, and this year's NOPAT is then compared with that. Otherwise, in all other sums, I have not seen any focus on T and T minus 1. Okay, this is economic value added. NOPAT is obviously EBIT into 1 minus T. There is only one ambiguous question from the ICAI study mat where they have not done by this formula. They have done by the formula EBIT minus tax, which means the tax calculated on PBT. So this is not correct, this is wrong, but this is used in one particular sum. So you have to remember that sum. You don't like it, can't help. Okay. Also in that particular sum, I remember even the capital employed, okay, the weights that they took for WD and WE, they did it wrong. Anyways, I will not try to speak about it. When I go to the sum, I'll show the sum to you. So this is EVA. Okay. Let's come to the practice of EVA questions. Perfect. So here you have question number 24. The 24 questions are there. The last question is on EVA. I'm opening the sum. Okay. So we have STR Limited's current financial year's income statement reported its net income after tax as 50 crore. This is net income after tax. It's not net operating income after tax. So it's not NOPAT, it's PAT. Net income is PAT. 50 crores. But if it's an EVA sum, we need NOPAT. So you have to convert PAT into NOPAT. Following is the capital structure. Debt 80 crores. Equity including reserves 250 crores. Invested capital 330 crores. Perfect. 330 crores. Following data is given to estimate the cost of equity, KE. RF is given 8.5%. RM minus RF is given 9%. Okay. So RF plus RM minus RF into equity beta, that is levered beta, but we are given the asset beta. So you know how to convert the asset beta into equity beta. You have to put leverage into it, into 1 plus D by E into 1 minus T. We'll do that. So we'll tax the rate 30%, calculate EVA. This is called a clean sum, no problems at all. Okay. What is the debt? 80. What is the equity? 250. So I'm not doing it in a very sequential manner. Okay, by decorating the board. Basically, my stance is how to calculate KE. So KE is RF plus RM minus RF into equity beta. Okay, equity beta is not given. So this equity beta is equal to the asset beta, unlevered beta, into 1 plus D by E into 1 minus T, correct? So everything is given to you. You know this asset beta, you know the debt, you know the equity, you know the tax rate. So you calculate the equity beta. You put the equity beta, RF is given 8.5, RM minus RF is given. You get the KE. Okay, I'm not doing it. So you get the KE. Perfect. You get the KE. Now, KC is obviously WDKD plus WEKE. Okay, do we have the weight of debt? Yes, we do. If you look at the figures, weight of debt is 80 by 330. Weight of equity is 250 by 330. Perfect. You are doing from CA into stuff. And KD is obviously 11 into 1 minus T, and KE you have already calculated. KD is 11 into 1 minus T, you can see that 7.7, and KE you have already calculated, so there is no problem in KC. Okay, KC and capital employed is already there, 330. So now you need no PAT. You are given the PAT was given. What was the PAT? PAT is 50 crores. PAT is 50 crores, tax rate is 30%. And interest is 11% of 80. So we have, from PAT I can calculate no PAT in two ways. One is by the shortcut method. Shortcut is no PAT is equal to PAT plus interest into 1 minus T. People are not comfortable with this generally. So 50 crores plus 11% of, what was it? 11% of 80. Into 0.7, 11% of 80 into 0.7. Okay, 50 plus 11% of 80 into 0.7, that is 56.16 crores, I think. But people don't like this method. The other method is you have the PAT, which is 50. So you calculate PBT, which is 50 divided by 0.7. What is it? 50 by 0.7 is 71.4. 286. Add interest is 11% of 80, which is 8.8. so you get EBIT. So we get EBIT equal to what? 71.4286 plus 8.8 is 80.2286. 80.2286. And then you do no PAT. No PAT is what? EBIT into 1 minus T. So the 70% of this amount, 80.2286 into 70%, 56.16. Look at the time wastage. So people should know that no PAT is after tax, PAT is after tax. Why should we do the taxation thing? But interest is deducted in PAT. Interest is not deducted in no PAT. So we got to add it back, but then the taxable issue comes in. So no PAT is PAT plus post-tax interest. If you know it, you are a more efficient person. Otherwise also you can do it this way. 56.16. So we have the no PAT. So EVA is what? EVA is the no PAT minus the KC, which we have calculated, into the capital employed, which is given. Okay. So you get the answer for EVA. Do remember that if we have EVA 1, EVA 2 and so on, and we pull them back, we get the MVA, market value added. And market value added is the excess of enterprise value over the capital employed. So the firm value or enterprise value is equal to market value added plus capital employed. And of course, from the enterprise value, if you deduct debt, you get the value of equity. So you should know the overall picture. Just that we are doing this sum, that does not mean that you have the alibi of not doing what was taught in class. Okay, we had done in class the entire structure of how equity valuation is done via the economic value added approach. Let's look at the solution. If we look at the solution here, they have converted the beta, okay, 1.36 they got the levered beta, they put it into the CAPM, they got KE 20.74, KD is 11 post-tax 7.7, then they calculated KC, which is 17.58, and then they've done all that stuff to calculate the no PAT, okay, 56.16 minus the KC into capital employed. Okay, that's the answer. This company is having a negative EVA. That means the company is destroying shareholders' wealth. It's not earning what it is supposed to earn. It's earning less than that. So somebody may jump that such a good company, it's earning 50 crores. It's accounting. You should calculate economic profit. Is it earning more than what is required? No, it's destroying shareholders' wealth. Anyway, so this is the correct sum of EVA which is given over here, and there is an incorrect sum. Okay, there is an incorrect sum which has come in the exam once and which can once again come in the exam. You know which sums are most important for CA final? The ones which are ambiguous and incorrect. So let me check that sum. Yeah, ambiguous sum on EVA. Question number 1. So question number 1 and question number 24. Question number 1. Okay, I'm opening the sum. So in this sum, calculate EVA. They have calculated EVA as EBIT, the 800 minus the tax amount 231. Whereas we do 800 into 1 minus T, but they have done 800 minus 231. In fact, in adjustment number 4, it's given bad debt provision of 40 lakhs is included in indirect expense and 40 lakhs reduced from receivables. So they have added 40 lakhs because it's non-cash. So 800 plus 40, 840 minus 231. What is it coming to? NOPAT in this sum is 800 plus 40 minus 231, 609. Sir, do we have to remember this? Yes, we have to remember this. Sir, can't we do the correct solution and then write a note? No, you can't do the correct solution. Correct edge, what is correct as per ICI? 800 plus 40 minus 231, 609. That's the NOPAT. And then the capital employed over here, you can find net worth is 1000 plus 600, 1600. And long-term borrowing 200. So 1800 is the capital employed, but because 40, the bad debt provision will be added back to debtors. So therefore the capital employed is 1840. Capital employed is 1840. Okay, 1840. Now, to calculate the cost of capital, they have ignored the 40. They have taken the cost of capital based on 1600 and 200. So you have to remember that although they added 40 to the capital employed, but then while calculating cost of capital, they forgot the 40 and they took it on the basis of 1600 and 200. So I don't like all this frustration. I can't help. Okay, I can't help. I am concerned with guiding you on how to get the best of marks while giving knowledge which was given in class. Perfect. So this was the wrong sum on EVA which is done in class. Okay, so very important sum. It can come in the exam again. Do not apply a concept, apply what institute has done. Next, let me now revise for you what we used to do in the sums on Alcar model. In the Alcar model sum, we have to find out the value of strategy, which is post-strategy value minus pre-strategy value. Pre-strategy, the firm is a no-growth firm, so pre-strategy value is simply NOPAT by KC. There is no problem with this at all. Post-strategy value, the firm is going to grow for 3-4 years. So this table plus formula. Table plus formula. Table, you have to calculate FCFF. When you do the table, say particulars, and in years 1, 2, 3, suppose 3 years growth is there, so you have to show the table for 4 years. 1, 2, 3, 4. There are some time pass items. Sales. They tell us sales will grow at what rate? It's time pass. You have to just show it. PBT. Time pass. PAT. This is useful. PAT is actually no PAT because in such sums, debt is not there. What the sums which have come up till now. If in your sum in the exam debt is there, you are not concerned with no PAT, you are concerned with no PAT. Understand? Since all the sums which have come in the exam, interest was not there, therefore I am writing PAT, because if interest is not there, PAT is no PAT. So these two things were time pass. These two things were not required, but they are written to get marks. You will also have to do them. And PAT is no PAT. Of course, in the 4th year, if 3 years growth, 4th year you just have to copy the figures. The 3rd year's PAT is the 4th year's PAT. 3rd year sales, 4th year sales. Okay, that way. The 4th year is just being shown as an extra so that we can use it in that table plus formula, the formula portion, no PAT by KC. Now, where does the problem arise? Now you have to find out the depreciation, the capital expenditure, the change in working capital. Now, There is no issue with this. There is no issue with this. But the capital expenditure portion is found out as a balancing figure. You may get confused. You will think I have written capital employed. It's capital spending. Okay. It is computed as a balancing figure. How? You have change in fixed asset in the balance sheet, add depreciation. So you will prepare a forecasted balance sheet where you will find the change in fixed asset, add the depreciation. That's how you get the capital spending. They want you to show this, otherwise there was a shortcut way of straight away calculating net investment as change in capital employed, but they don't correct it that way. So depreciation, don't worry, clue will be there. Change in working capital easy, but the capital spending will be the change in the fixed asset in the balance sheet plus depreciation. So the balance sheet forecasting, you have to do balance sheet. So fixed assets, so you have to grow them year 1, 2, 3, 4. Current assets, you have to grow them. Okay, and then your equity. Okay, you have to grow it, and you may also have some current liability. Okay. So that way. So basically, when you grow the fixed asset, then the change in fixed asset is known from here, which I was talking about. The current asset and the current liability, CA minus CL is what? Working capital. So whatever working capital was there in the balance sheet, this one minus that is a change in working capital. That's easy. Depreciation, they will tell us the depreciation rate. So it's a very easy sum. Okay. Let's come to the sum. So I'm coming to the sums on Alcar model. Question number 2. Question number 2 is on Alcar model. I once again repeat, what do they want? They want the forecasted balance sheet from you in the answer. Forecasted balance sheet, they want the statement where you have computed the cash flow, free cash flow for 3-4 years. Okay, and then the present value and all that stuff. So the presentation has to be 100% correct. So this is the income statement given. You can see there is no interest. So this 4,200 is actually no PAT. Balance sheet is given FACA, equity share capital, creditors. Company is contemplating new strategy, sales to grow at 30% for 4 years. Okay, sales. So 1, 2, 3, 4 and the 5th year extra will show. Asset turnover, net profit ratio, tax rate will remain the same. Depreciation 15% of fixed asset at the beginning. Required rate of return 15%. Evaluate the viability of the strategy. So what is the pre-strategy value? The pre-strategy value is 4,200 divided by 0.15. No PAT by KC. 4,200 by 0.15. It's coming to 28,000. 28,000. Okay, 4,200 by 0.15. 28,000. Now you have to prepare the forecasted balance sheet. Can you see fixed asset 10,000 into 1.3, 13,000 into 1.3, 16,900. Current asset 6,000 into 1.3, 7,800 and so on. Total asset. That way equity share capital 15,000 into 1.3 into 1.3. Sundry creditors into 1.3 into 1.3 total. That way you have to calculate the forecasted balance sheet. It's very simple. See, fixed asset, current asset, all 30% growth. And then you have to draw the projected cash flows the way I told you. Okay, and then the PV and all that stuff has to be done. The sum has been done in class. It's just that it's very important for the exam. So I wanted to focus on it, and therefore, since I am feeling it will come in the exam, there are, I think, 3 sums on Alcar model which I have taken. Question 2, question 3 and question what? 23. 2, 3 and 23. I really want you to do it in a written manner or on the calci in a rough manner. You got to do it right, please. It's very likely to hit the exam, either Alcar model or EVA, and therefore I've done it. Now these two are such boring topics that I don't feel like recording another 15 minutes of a video right now. So I'm stopping the video over here. This becomes the equity valuation SFM Dawn series class 1. Okay, thank you.